Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Kalman Saffran of Summa Management. Kal, thank you for joining us.
My pleasure.
Can you tell us a little bit about your background before joining Summa Management? What did you do before this project?
Sure. I had a fairly diverse background. I started out as a physicist at the Laboratory for Nuclear Science at MIT, and then I moved on to becoming an entrepreneur, and I founded 3 companies, the latest of which is Summa Management. And in between those things, I was also a corporate staff member at a Fortune 100 company called United Brands Company. So quite a diverse background. I consider myself a businessman / scientist / engineer.
Well, that's great. So what led you to start working in the big data and the AI space? What attracted you to that space?
My partners and I decided to speculate in securities with some of the money that we made from the sale of our last company. And when we researched the state of the art in that field, we determined that a new theory had to be developed, and that theory would be dependent upon large amounts of data and large amounts of processing. So we took a so-called big data approach to the data and an artificial intelligence approach to the processing.
So for people who are investing in that space of big data AI, what's your advice for them? What should they be looking for?
I think they should be looking for new and out-of-the-box approaches, because although quantitative trading these days is quite popular, probably 1/3 or more of all trading is done quantitatively now, not too many quantitative firms actually produce high returns. And part of the reason is that they're all following the same outdated models for quantitative trading, either reversion to the mean or trend following. So I would say that investors should look for new out-of-the-box approaches to quantitative trading. Those should hold the highest returns.
That's great. So the industry is moving very fast, and how do you see it evolving in the big data AI space, in particular with the fintech application you have?
Well, the world is moving toward quant trading as opposed to discretionary trading, or in the vernacular, some people might call discretionary trading stock picking in the stocks part of the securities industry. So things are moving toward quant, and they're moving toward innovative approaches and processing more and more data in essentially non-human AI type ways. So the industry seems to be moving toward more and more data, more and more AI type processing, and I think that will be continuing for the foreseeable future.
For a while, it seemed to be speed of execution. It seems like now it's taking a different vector into who has the best data and who has the best algorithm on top of the data. Is that true?
Yes. The speed of execution is an area of quant trading called high-frequency trading. And that has its limitations in many dimensions, including potential return and amount of return per trade. High-frequency quant traders make fractions of a penny, in a lot of cases, per share, per trade. While that can result in absolute fairly large amounts of money, it's a very small amount of money compared to other forms of trading. As an example, certain quant trading firms make in one quarter what the whole high-frequency trading industry makes in 1 year. So the high-frequency end is the lower return end, and it's becoming out of vogue because of the government's interference with it, because of supposedly unfair practices that the high-frequency traders may be using or may not be using. So I think the market is moving toward predictability as opposed to speed of execution. So speed of execution is essentially a means to an end as opposed to the end. And predictability, high predictability, is really the most lucrative method of assuring high returns. So I think the market is moving toward determining high predictability. And some of that can be done at medium frequencies, faster than humans can type, but not in microseconds or even milliseconds as the typical high-frequency traders operate.
So for investors who want to invest in this space, especially the quant trading with the AI data analytics angle on it, what's the investment thesis there? How does one quantitate or quantify what is a good company to invest in based on the big data they have and the AI algorithms? How does one measure that piece for an investment thesis in this sector?
Well, I think that probably one requirement is that it be something new and hopefully revolutionary, because the old systems simply haven't performed. If you look at the performance of the quant trading industry last year, as an example, 2018, you'll see that their returns were around zero. There were a few with a little profit and a few with small losses. And part of the reason is because they're all doing the same thing to one degree or another. So that's proven basically not to produce high returns. And therefore, I think the proper approach for investors in the segment is to look for firms or types of investments that are outside of the mainstream of classic quant trading.
So what are the challenges with the old approaches, the trend following and the other ones that people use? Why did those not work?
Well, part of the reason is that everybody is doing a similar thing, and there's simply not enough capacity for everybody to do the same thing. One has to be unique. So I think that's the main reason. And a secondary reason is that there are all sorts of different data sets out there that could be deployed, and those data sets can be quite expensive. So the cost of technology is extremely high these days, and not all firms can afford to buy the data necessary to process.
So where does Summa Management fit into that picture of that landscape of quant trading?
Well, Summa Management, the company that I'm CEO of, has, in our opinion, a revolutionary approach to quant trading. It is not correlated with the old approaches of reversion to the mean, trend following. We have a unique approach, and therefore we have the possibility of much higher returns than the classic approaches. And because of our technical background, myself and the other founders and most of the principals of the company beyond the founders are former MIT people, and we tend to be very technical, so big data and AI comes to us fairly easily. Some of us were around when Marvin Minsky, an MIT professor, invented the field of AI several decades ago. So I think the fact that we are doing something new, revolutionary, out of the box is the basis for our system, and the fact that we're very technical and have implemented a sophisticated big data / AI system is what will allow us to achieve the returns that we project.
So as you apply your technology to the big data AI space, what have been some of the challenges you had to overcome? Is it quantity of data? Is it the change of data? But what seems to be the key challenge you have to overcome to make it work?
I think there are probably two key challenges. One is the ever-changing nature of markets. What a market is today is not necessarily what it will be tomorrow, and the same last year versus next year. So one has to keep evolving the technology, the algorithms, the data necessary in order to keep up with the market. That's one challenge, so I'll call that an operational technological challenge. And the other challenge is that data is quite expensive.
Do you see the cost coming down because of the amount of data becoming more available to people? Or do you think the cost will remain high because it's just a scarce commodity and people will always want it?
I think the latter. We see the costs going up, not down. If you look at the New York Stock Exchange and NASDAQ these days, they make most of their money not through trading, not through commissions on selling stocks and bonds. They make most of their money these days from selling their data. And they've They charge very, very high prices for certain kinds of real-time data that's unique to them. They have a monopoly on certain data since they're the originator of it, and therefore can ask high prices for what the market will bear. It was estimated last year that Goldman Sachs spent $847 million on data. That's just one company, and it's an enormous amount of money. So we see the cost going up. Now, fortunately, we access and curate most of our own data, but we have to buy certain data, pricing data from the exchanges, and due to their monopoly, they keep raising the prices, not lowering them.
Well, that's fascinating to see how the market is shifting into a data play away from a high frequency play and seeing how that goes. In the last few minutes that we have here, what else should we cover?
Well, I think I'd like to make a point about track records in the stock market. In order to determine, I think as Warren Buffett used to say, you don't know who's wearing a bathing suit until the tide goes out. And similarly, in the trading markets, you really don't know who's successfully trading until many years pass because of the rules of the stock market. There have to be a lot of winners in the stock market. It's not a game like chess or checkers or the lottery where there's one winner and one loser, or one winner and 100 million losers. In order for the stock market to continue as it has for centuries, there have to be a lot of winners. So based on probability theory, one can see that every year there have to be a lot of winners in the stock market. And in some cases, based on the rules of the game also, just by luck, there can be winners 4 or 5 years in a row. When you get up to 20 years in a row, that's what separates the real winners from those who were merely lucky in the shorter term. So I think the trading markets, the stock market specifically, one has to be very cognizant of the rules of the game when assessing it and understanding that there will be a lot of winners, and knowing who won based on skill and who won based on luck is not easy to determine.
Well, great. Well, how best for listeners to get back in touch with you?
I think they could go to our company's website, Summa Management.LLC.com, and on there is contact information for me, both email and voice.
Great. We'll include those in the show notes. Appreciate your taking time to share that with us today and hope to have you back for a follow-up soon.
My pleasure. Thank you very much.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.